All right, day 473. Today, we are adding to our comparable sales list. Why are we doing this? All right, let me show you what we're doing. So, I've been filtered on and looking for properties that are 4 bedroom plus, single family homes, and looking for properties that have been on the market for less than 3 days. And that's how I came upon this property in 737 Dolphin Drive, Birmingham, Alabama 35214. Beautiful and newly renovated at 195 grand roughly. And this is 1418 square feet, which is roughly in line with all the properties that I've been looking and seeing in this market for 3 bedrooms plus, because I'm usually looking at 1200 to 1500 square feet where there's a opportunity to add an additional bedroom. Now, the reason I'm doing this and I'm making this list is if you've been following what we've been doing, right? For the past 12 months, we've been adding and creating a list of properties that have been sold and all the related details, right? Like the bed, bath, square footage, the year built, the sold price, price per square foot, the sold date, the lot size, whether there's a garage or whether there's a basement. These factors will be different by neighborhoods and markets. Whether it's an HOA, whether or not it's in the subdivision or what neighborhood it's in, and some general conditions about the home, like some comments about the condition of the home. Once we exhausted that list, then we started looking at properties that were only sold in the last 3 months. Then I started tracking properties that have been coming onto the market. Now, why am I doing this, right? I want to be ahead of the curve. I want to understand what are properties coming on the market for and what are they being sold for on a dollar per square foot perspective. Because if you understand how the 30-year mortgage interest rates work is, well, guess what? It's dependent on two things. One is the interest rate of the 10-year treasury yield, which right now is at 4.65. But if you can look at the yearly rate, I mean, it's nearly at the 12-month high. I mean, it retreated a little bit from the 4.8 it was at yesterday. But here's where we're at. We are now going to see that the interest rates, hopefully it pulls back more. But if not, if it continues going up, then I mean, there's a very good chance that the affordability continues to go down. Because as your interest rates go up, your affordability goes down because your monthly payment goes up. All right. Now, the other factor that the 30-year mortgage interest rates are affected by are the spread between the 10-year yield and the 30-year mortgage interest rates. Typically, that spreads between 1.5% to 2%, but it's gone as high as 3%. That's when we saw interest rates in the eights, roughly. So that's why I'm tracking what are properties coming onto the market because of the BRRRR strategy. Now, the BRRRR strategy stands for buy, rehab, rent, refinance, and repeat. Now, let's use an example so that we can understand that strategy better. Let's say you buy a home for $30,000, 30, and you renovate that home for 40 grand, 40. So you're all in now on that property for cash invested out of pocket at $70,000. But if you're able to make that home worth 100 grand, right? You created $30,000 equity from that 70 grand, and then you had $30,000 equity to make your 100 grand number on top. Well, now you can go get a debt service coverage ratio loan, a DSCR loan, and refinance that for 70% of the home's value. So you can take back out 70% of 100 grand, which is $70,000. So you're able to recuperate all the money that you invested in the form of a loan proceed. It's not taxable, but what's the advantage here? Now, all of a sudden, you take the same $70,000 and put it towards the next deal. And then you rinse and repeat using the same pile of cash over and over again, as long as you have the right team, etc., in place. So, what is that alternative if you don't pursue the BRRRR strategy? Well, typically people might save up for a 20-25% down payment from their full-time job, buy a home, buy an investment property, hope that it cash flows or hope that it goes up and appreciates, and save up money from their job again to put towards the next property. Well, that could be really slow, right? Now, I'm not saying that can't be successful. Lots of people are successful doing that. But you have to understand, what is your goal? What is your strategy, right? At the end of the day, this is not investment advice. We're not soliciting any investments on this call. We're just showing you how to think about approaching, analyzing a deal, which we're going to do shortly. But you have to understand, why is each strategy advantageous? And most importantly, for the BRRRR strategy, what's your biggest risk factor? Your biggest risk factor is, as we talked about earlier, right? If your home is worth an after repair value, ARV, of 100 grand, you can get back out all your capital. But what if you were wrong in estimating the ARV, right? That's why we're tracking all these properties, because you have to see what a property is being sold for as they come on the market. Because if you're relying on a comparable sold property a year ago, and now properties are selling for $10 or $20 less per square foot, you run the chances of leaving a lot more capital in the deal, and that slows down your ability to scale dramatically because of the amount of capital that you're leaving in the deal. All right. Because if you think about it, what's like the perfect comp? Like the perfect comp might be, hey, if this property right next to it is the property I'm buying, and this property already sold, obviously, and I'm looking at this property, and it's the same bed bath count that I'm trying to renovate towards this home, and same square footage, same year built, same lot size, blah, 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 that would be my perfect comp. But that typically is not the case. Usually when you go across man-made borders, such as these big main streets, Forestdale Boulevard or Veteran Memorial Drive, or you cross natural barriers such as these creeks, these rivers, etc., or railroads, now you're in completely different neighborhoods. So the risk of your ARV being incorrect, if you're trying to renovate this home, but you're trying to use a sold property all the way across the other side of the city, that's not a very good comp. It's a completely different neighborhood. So that's why you got to track by zip code, by neighborhood. So for this property, let's write this one down, right? This property, 737 Dauphine Drive. Let me just write down these addresses. This is in the Forestdale neighborhood, because that's the closest listed neighborhood right here. And let me write down this in 35214. 42, and this is a 1418 square foot. This property was built in 1981, so relatively newer home. 149,900 is the listed price. Oh, 194,900. Sorry, 194. Whoops, flip that backwards. So, from a dollar per square foot perspective, this property is going to be sold for 137, assuming it gets sold as is. This was just listed a day ago, so it's 114.25. 0.3 acres, 0.34 acres, no garage, no basement, no HOA, right? I didn't see it from the photos. Yeah, okay, great. Now, this is in Forestdale. And now for the conditions of the home, I just typically look at the bathroom, kitchen, flooring, and it looks good for the most part. There's only carpeting in one bedroom, so I can write this one down. So, newly renovated, above average kitchen with white cabinets, and not super modern, above average bathroom, no painting needed, maybe just one room needs carpet to be replaced with LVP. Great. So now I understand the condition of this home. I can always go and refer back to this property if I'm ever looking at a property in this area and seeing whether or not this property is worth my time. Okay. Now, let's analyze this deal as is if I were to buy this property on the market. So this property, right, is being listed for 194,900. So I'm going to go to my spreadsheet, 194,900. This is, I'm going to delete this, multiply by 2 here. And my rehab calculator here, let's see, for this home, I'm going to set aside $1,500 for the roof, just in case there's any issues with the roof, because they didn't say anything about a new roof being put in place. Got $500 for some landscaping to kind of keep in there. I don't need to replace more than 300 square foot of flooring because I only saw one bedroom with carpet, and that's my personal preference to replace it. And there's 2 toilets that I want to replace with high pressure flush toilets because I don't want any clogged toilet calls. Typically, if you ever get a plumber that goes out there for a plumbing call, for a clogged toilet call, it'll probably cost you $100, $200. If you had to replace that toilet, it's another $200. I just want to get that done out in the beginning for about 450. And so my total rehab for this home to get it to the standard that I want to be rent ready is about 6,300. Okay. So that's right there. Now, the next thing I want to do is get my rent. So if I go to affordablehousing.com and I go to the owner section and I go to the market rent estimator, I can plug in the address, plug in a bedroom count, and I can see here that the average rent for 25 units within a 4.6 mile radius is 1,515. So I typically have seen properties closer to 1,400. So maybe I'll do 1,450 as the midpoint between 1,500 and just underwrite it as that. Okay. Obviously, you got to talk to a property manager or local property management that can probably give you better estimates, or you can go to Zillow and see what are properties being rented out for in this area, right? If you go to Zillow and you simply go to for rent and you look at 35214, now you can see what properties are being rented out for that are 4-bedroom plus, and they are single family homes, right? And you can see that this property is being rented out or listed for 1,410. 4-bed, 2-bath, 2,339. That's pretty close to our home. This property is 5-bed at 1,775. That's a little bit too big for us. This is 1,400. So again, I'm seeing a lot more properties being listed for 1,400, which is much more in line with what I've been hearing and expecting. And this property is great because you see that it's been on Zillow for 6 days and there's been 11 contacts. As a general rule of thumb, if you want to see that it's priced correctly, you probably want to see that for every day it's on Zillow, you get 1 contact. If you get a lot more contacts, chances are you might be slightly underpriced. So let's look at the other property at 1,410. This property is listed for 6 days with 17 contacts. So yeah, you might be able to get 1,450. But again, this home is a lot bigger. So just be very, very careful about that. All right. So at 1,450, that makes me feel pretty good about the estimate. Now, for my property taxes, if you see down here in the payment calculator that the property tax estimate is 41, that seems a little low, to be honest. You should definitely double check with your county assessor records to double check on whether or not that $41 estimate is correct, because that seems really low to me. So on top of that, what you want to do is for the insurance estimate here of $151, I'm assuming that 151 is assuming that someone's going to live in that property as a primary residence. And if I'm not going to live there as a primary residence, then I'm using it as an investment property. And insurance companies typically view your property, if it's used for investment, as a riskier asset. So you're going to charge you more premium. So that's why I'm multiplying by 1.2 to add a 20% premium to be a little bit more realistic with the numbers. Again, you don't have to be exact. I mean, obviously, you should get an insurance quote before you close on a property. But all I'm doing right now is figuring out, hey, whether or not this property is worth my time with the price and set of terms I have as is. So the next item I have here is the 10%. So every single day, every single month, I'm setting aside 10% of my rents for maintenance. So this allows me to say, hey, I'm setting aside $145 every single month because I know at some point, right, 10, 15, 20 years, that roof is going to get replaced. I know in 10, 15 years, the HVAC is going to get replaced. Same thing for my water heater. If you know, and you're a buy and hold investor, right, these are expenses that you cannot avoid. You have to understand that you got to put aside this money now. Because otherwise, you're underestimating your expenses and overestimating your profitability. And that's not responsible. And don't ever trust anyone that tells you, hey, there's no maintenance because it's turnkey and it's a new build, whatever. There's always going to be something that comes up. All right. Then I got 10% on my rents set aside for property management expenses. And I got 5% on my rent set aside for vacancy. Now, property management, yeah, sure. Could you self-manage it and not incur expense? Absolutely. But if you don't underwrite with property management expense right now, then you are essentially buying yourself a job, right? Because you are the property manager. And if you are pursuing real estate because of financial freedom, freedom of time, freedom of choice, blah, blah, blah. I mean, if you don't underwrite with property management now, then you are essentially unable to get out of that job in the future. That makes sense, right? It might not be profitable unless you self-manage. And that might not be the reason why you pursued this in the first place. So just be very cautious about this, all right? And the 5% for vacancy just means that I know that someone's going to move out at some point. It's just inevitable. All right. So I got 25% down in F19. So my down payment is equals to my B4, my asking price, times my down payment percentage of 25%. So that gives me a total down payment of roughly around 49 grand. I got 2.5% for closing costs, and I got my $6,300 for my renovations. So if I finance the balance, right? So that'll be B4 minus my down payment amount. I'll be financing 146 grand. I'm going to use 7.5% interest rate for now because interest rates are kind of a little bit higher than usual. I'm going to do 125. Great. And assuming all those factors stay the same, right? I'm buying from 195 with 100 or with a 1450 rent. Let's write down the scenario. I would be negative cash flow, negative 157 cash flow, losing $157 a month, which is a negative 3.1% return if I bought this property for 195, just using round numbers here, right? Just to be sane. Assuming a 25% down with a 7.5% interest rate. Now, let's say I can get to 1,500, right? That's my max. I think that's a little aggressive, but hey, if you want to be aggressive with your estimates, that's still not a deal, right? Because at $1,500, assuming everything else stays constant, I'd be at 195 grand, $6,400 rehab, 7.5% interest rate. But now I am only losing $119 a month as a negative 2.4% cash on cash return. Now, again, I'm not saying 10% is the magical number, but what is your number to justify the execution risk that you're taking on? Because what's execution risk, right? It's whether or not that owner or that seller or that contractor say that what they're going to do. Is that contractor going to show up on time and stay within budget? Rarely the case. I rarely hear that someone says, hey, I finished that project on time under budget. It doesn't happen that often. So with that said, what can I do to the purchase price to make this worth a 10% return? Again, not saying 10%. Again, not investment advice. All right. So I go to $108,000. Now, how about 115? 113. There you go. So at $113,000, this would satisfy my required target return of 10%. Because now I'm able to cash flow $310 a month. Again, I'm assuming I can rent it out for $1,500, not $1,450. All right. So hopefully that makes a lot of sense to you guys. All right. Well, what if my interest rates drop to 6%? So maybe if Fed decides to lower the rates, the Fed funds rate a lot more, or give some dovish signs to indicate that they're going to cut rates more after the Trump administration comes in, who knows? Your job is not play politics. Your job is to react and be prepared for what's happening in the market. So if it drops to 6%, right? Pay attention to 10-year yield. Make sure you do that. My cash on cash return, I'm just jumped 2.65. So now I can afford to, let's say, pay a $10,000, 125. There you go. I can afford to pay 125 grand now, assuming everything else stays constant from the prior scenario. Sorry, $6,400 rehab, 25% down with a 6% interest rate. I can now afford to pay 125 grand because I can cash flow 341, assuming I can rent it out for a 4-bedroom. Now, let's do one more scenario. Let's say your rehab tripled because you found something or you realize the roof needs to get replaced after you walk it and you had an inspection contingency. So now you triple. So now your rehab is 19 grand. What are you going to do? Panic? No, plug in your numbers and revalue the scenario. So you can see that it dropped from 10% to 7.65 since I tripled my rehab. So in order for me to achieve a 10% return, how much do I need to lower my asking price by? If I go down to 110 grand, great. Now I'm back at 9.9. Even with my rehab triple to 19 grand, assuming I'm still getting a 6% interest rate. Because now I'm able to cash flow 408 with a $1,500 rent. Now, I'll do one more scenario just because this is such a great conversation today. Let's say your rent goes back down to 1,400, right? Because you're trying to get it rented out as soon as possible. And you see that there's a lot of demand for houses that are 4 bedrooms for 1,400. If you go to 1400, guess what? It just went lower to 8%. So what's your risks? Your rehab still tripled, but now you might get 100 grand just to get back closer to it because now you're at 9.7. So just like that, if you are trying to say, I'm going to assume I can only get $1,400 rent instead of $1,500, even though my rehab tripled and my interest rate is at 6%, with 19.9 rehab, I would be okay with a 100 grand purchase price. Now, does that mean you're going to get it for 100 grand when it's listed for 195? I don't know. Maybe not. Probably not. But at least now you know the scenario that you went through to go through the exercise, to take emotions out of the deal, and understand how do you adjust the levers based on new information that you have instead of getting emotionally involved. So I hope this was helpful, everybody. I've been doing this for a while, and I'm so grateful that you're staying consistent with me. My hope is this, is that you copy my homework today, analyze the same deal and analyze today using the same spreadsheet, right? This property has been on Redfin for just one day. I didn't make this up. It's right there. And use the same spreadsheet, right? If you guys want to copy the spreadsheet, go to affordablehousing.io, go to the Get Deal Analysis tool, plug in your name, your email, your phone number. That's the fastest way you get a copy of the spreadsheet. And my hope is that you put this on your own YouTube channel. Because at some point, someone's going to ask you, hey, why do you think this is a deal? You can tell them that this is a deal because you've been looking at deals for the past 473 days. And you can point them to your own YouTube channel at that point in time. Say, hey, this is my proof. Might that make you feel a little bit more confident that you know what you're doing? I certainly hope so. All right. I hope this was helpful, everybody. If you guys have not seen our latest podcast, check it out with Brian. He talks about how they were able to create effective, cost-efficient housing for the homeless in Northern Ohio, where they did the numbers and they saw that it used to cost $26,000 to support a chronically homeless individual. And after they built the home, it cost them only 15 grand. Those are real savings. And it's just really interesting to see how other cities, how other counties have sort of figured it out. Now, the magnitude of problems might be different across different states, but at least you can take lessons from what has worked from others. And you can learn from Brian's experience on how he has gotten projects approved in the development world, especially when it comes to affordable housing. So I hope this is helpful. Definitely check it out. This is going to be interesting. Please, please, please support the podcast. And I would be so grateful if you guys can leave a 5-star review on Apple Podcasts or Spotify, and so that we can continue spreading the word and create more affordable housing. Thank you so much, you all. I appreciate you all so much. Thank you for staying consistent with me. Thank you so much for the supportive comments that you guys leave on the pages. I'm so grateful. Without people like you, I would have never had the home I grew up in. So I really mean it. I appreciate it so much. Thank you so much for keeping me and encouraging me to keep going. Thank you so much for telling me that the content is valuable. It means a lot more than you know. I appreciate you all so much. All right. Have an amazing Wednesday. Spend some quality time with your family and friends today, because that's what life is all about. All right. Have an amazing day. I'll see you all tomorrow for day 474. Have a good one.